This is the Policy and Taxation Group webinar, webcast, I should say. I am John Marino, Director of Family Office Engagement for Policy and Taxation Group. Our organization is the voice of family offices and financially successful individuals in Washington, D.C., focused exclusively on the critical tax and economic issues. We are very excited to have Dividend Assets Capital featured in this webcast. We are joined today by the CEO of the company, Jim Haley, as well as his colleague, Mark Sauerborn, who is the Chief Investment Officer. We will be addressing the timely topic of, would you like more income every year? This webinar will explore issues including dividend growth of double digits over a decade or more, or what Dividend Asset Capital refers to as 3D investing, which provides a more dependable, repeatable pattern of overall performance and total returns. No matter how good the analysis or forecasting of how attractive an investment looks on paper, it cannot compare to an investment that performs well in the real world. If you have any questions over the next hour, please put them in the chat. We'll be happy to address them. I'd like to let you know that Policy and Taxation Group provides these webinars as an informational platform and to serve as a resource for our supporters. Quick disclaimer, I am not, nor our organization, providing any financial, tax, or legal advice. So without further delay, let me turn it over to Jim so he could tell us a little more about his company, and then we could dive into his presentation. So Jim, please go ahead.
Thank you, John. We appreciate that introduction and the kind words. And as John said, I'm the CEO of the firm, and I'm here with my colleague, Mark Sauerborn, who's our Chief Investment Officer. Combined, we have nearly 60 years of experience in working and serving the needs of our client base, which is successful families and business owners. And those unique needs are anything from their investment needs to their estate needs to their charitable gifting needs, even to their business valuation needs. We'll bring those resources in. So very much grateful to be invited here to talk today, and very much grateful and proud to be a supporter of the Policy and Taxation Group. John and I met a little over a year and a half ago, and I think we've all developed a pretty good rapport. And the work that they do resonated with me, and it resonates with the client base that we work with. As we said, many of our clients are successful families and business owners, and the work the Policy Taxation Group does very much resonates with them. It's one of the leading concerns that our clients share with us around taxes and policy coming out of DC. So thank you, John. We're great for that. So a little bit about DAC and what makes us unique and different. We are 100% employee-owned, registered investment advisor. That's definitely unique in our industry to have an employee-owned firm in this space. What also makes us unique is that we have a private client group here. We also have an institutional retail management group of this business too. So we are the managers that are hired when your financial advisor or your RIA or other intermediaries say, we're going to select this manager. We're usually one of those managers. So what also makes us unique is that we have a very disciplined, focused process around what we do with dividend growth investing. And it's the discipline and the focus of that process that allows us to have the success we've had. That process is really focused on, you'll hear it a lot around our firm, it's 10-10, 10 years at 10%. We only look to really build portfolios, invest in companies with a 10-year history of growing their dividend at an average growth rate of 10%. And believe it or not, there's the entire investment universe. There's only 180 companies that meet that criteria. So there's thousands of stocks listed in the market to trade, but only 180 of them meet that criteria. So the other thing that makes us different, unique in that discipline is, and as you'll see through this presentation as we talk, is we're focused. The dividend is cut we look to move away from that company. If the dividend drops below 10%, that growth rate drops below 10%, we will watch that company for a couple quarters. And if it doesn't rise above 10%, we will look to move away. The other one is if something fundamentally changes with the company, we'll definitely look to move away from that company as well. So you'll see that through this presentation, why that's important. So the third thing that makes us uniquely different is that we have a 50-year legacy history here in this firm of dividend growth investing. Not sure if you all can see the gentleman on this wall. Our founding partner here is Tom Cameron, who is known as the godfather of dividend growth investing. And we have been very fortunate to carry forward his legacy, as well as our founding partner, Joy Shaver, and some others, Jerry Estes, who have all helped really early pioneers of dividend growth investing. So it makes us unique as well in this space. So those are going through that, makes DAC different. And the other, as we move through this slide, kind of what we're talking through today, most of the folks on this presentation, I don't want to assume they're business owners, but I'm assuming there's some business owners here. There's only 6 things that you can do with your profits as a business owner. You reinvest it into the company, pay down debt, you do some merger and acquisition, maybe you do some cash retention program, you do some buybacks. You see that a lot, stock buybacks, which companies do to help increase earnings. But our favorite is the number 6 is you use those profits to pay dividends. And we want companies to use those profits who not only pay dividends, but grow those dividends. And it's also unique in that it's the cleanest and easiest way to kind of share in part of the profits. But you also know with growing dividends, you're going to share in part of the profits and the earnings going forward. So that's really makes us unique. So out of all the things we're going to cover today, if you could walk away with 3 things, is the 10 years at 10%. That is powerful. One of the things we are going to be talking about in here, because all of our clients are trained, and a lot of them are trained, they ask about yield on cost. And that is powerful. And the third, if walk away from it is a greater likelihood of achieving capital appreciation, principal growth, a steady rising income stream with dampening market volatility or dampening volatility of a portfolio. So those 3 things, 10-10, yield on cost, greater likelihood of growing principal, definitely a greater likelihood of growing an income stream, sustainable income stream, while making sure you're dampening and maintaining volatility of the portfolio. So with that, I'm going to turn it over to my colleague, Mark, and go through this presentation. And we'll be answering questions halfway through, and we've had some great questions already come in, so thank you for those. But we'll be pausing to answer some more as we move through this presentation.
So thank you, Jim. So the first concept we like to talk about is dividends contribution throughout history to the total return of the stock market. I think it's probably not well understood, remembered, that since 1930, if you look at market performance, about 40% of that total return was generated through dividends. That's pretty powerful stuff. But even during the 50s, or seriously, 60s, 70s, and the 80s, when again inflation averaged closer to 5% than historic 2%, dividends produced about 54% of the total return. So in an era more recently, when capital costs were 0, we think that environment is not going to continue going forward, simply for the fact that inflation is going to remain a problem, we believe, for the foreseeable future, and the fact that a lot of excesses were built up to the economy as a result of this free money that we're actually navigating through today. So we think that similar to during the 60s, 70s, and 80s, the dividends are going to be a greater contributor to total return of market going forward. So dividends are going to matter more going forward than they have over the past 15 years. So one of the things I'd really like to focus on is talking about the superior contribution of companies that have and grow dividends versus the overall market. And one of the things we want to highlight is that if you look at over the past 50 years, since 1973, the dividend growers and initiators have contributed sort of a 10% to total market return. If you compare that on a basis to companies that have not paid dividends, there's been significant performance difference. So, we talk about, the Nifty 50 going down to the Fab, to the FANG stocks, the Fab 5, Fab 4. When you look at throughout history, dividend growers and initiators have contributed much more to the overall market returns than they're given credit for.
That's right.
And then if you compare that to dividend eliminators and cutters, they're actually down, which is pretty astounding. You think about the overall market performance, they're actually down on a reported basis.
Right. And what's unique about this chart and aligns with the data, all we hear about today in the last 18 months is the Magnificent Seven, the Magnificent Seven. Well, if you look at and track a portfolio of dividend paying stocks, utility stocks, plain, simple, boring utility stocks, and you looked at the average return of that portfolio versus even all your these growth companies, NASDAQs for the last 30, 40 years, your utility stocks actually would have performed better than even those fancy tech stocks
On a total return basis. And it's because of the power of their dividends, the compounding impact.
Right.
So here we talk a little bit about address the reduced market volatility. So I think the major takeaway here is that over long term, investors have generated greater returns with higher risk. They focused on dividend growth companies. And so, one of the things we think the reason why is that, dividend paying companies tend to be more profitable just generally. They have capital discipline because they made a promise to shareholders of other dividends. And remember that they have excess free cash flow typically because dividends have to be paid with cash. So even during periods of time when the market has become more volatile or there's been economic uncertainty, dividend growth companies have offered a smoother ride through the rising income and a higher exposure to the companies we talk about as pricing power.
Sure.
So if we look at volatility and the measure of standard deviation returns, overall dividend growth companies have done very well on a risk-adjusted basis versus the overall market. So this is the measurement of more the broad market. It includes also small cap stocks. And it's even more significant if we actually look at some of the more traditional larger cap stocks. We're using the S&P 500 as a proxy. Comparing again dividend payers, which we focus on, non-payers and dividend cutters, we can really see here, even over the past 50 years, and so this is looking at a total return basis, the dividend growers have had higher return at a much lower risk, again, measured in standard deviation, than either dividend cutters or non-dividend paying stocks. So want to highlight that, if past is not prologue, but history serves as an indicator. These characteristics are likely to continue going forward.
Right. And the reason why this is important too is we get this question asked all the time. Why is this? Remember, these are high quality companies that folks know are going to more than likely move through that business cycle or that volatile period. So there's a rotation into these companies. So, and you can see that whenever you have market volatility, you have a rotation into these type of companies, into these dividend growers.
Mm-hmm.
That's part of what helps dampen the volatility.
So next thing we want to talk about, Jim alluded to this at the beginning of the presentation, talking about yield versus yield on cost. So yield is simply a company's annual dividend divided by its current stock price, but it's really just a measurement at a point in time. So we believe it's not a very good predictor, a forecaster of future income, because it's so reliant on stock price, which we just can't predict. So we think a better measurement is investing like Warren Buffett, who if you read any of the Berkshire Hathaway annual letters, he often praises, he discusses in great detail about his investments in Coca-Cola and Apple and some different stocks, but he also talks about his yield on cost. Basically, what that alludes to or is analogous to is their dividend divided by his original purchase price. So it's basically equal to his cost basis. And we believe it's a much better indicator of your future potential income because it's a measurement of your personal yield on investment. Remember, it's independent of the value of the price of the stock in the future. It really is measured based upon the growth of your cash flow from that investment. So I would encourage anyone who's, there's probably some people on this call that listen or aficionados of what Charlie, the late Charlie Munger and Warren Buffett have achieved. But a lot of the principles are the same that we deploy. And this is more of a practical example of that yield on cost over time, showing actual stocks. So I'm going to say Ameriprise and Sherwin-Williams are companies that are in our universe versus AT&T, which is not. And so the important point to note here is that even though both Sherwin-Williams and Ameriprise, at least initially, if you went back 10 years, started at a lower yield, because of their growth in yield and AT&T sort of lagging yield, over time, if you go over a 10-year measurement period, the actual income production at the end of this was much greater for Ameriprise and greater for Sherwin-Williams. This has nothing to do with the stock price. This is completely independent. So AT&T, because it was not a dividend grower, its yield stayed quite consistent. So at the end of 21, it only produced a yield of roughly 6.8%, not very much higher than where it started. Yet, if you look at the stock performance, again, we're connecting these dividend growth companies to stock performance. There was a very significant difference in this performance. Ameriprise and Sherwin-Williams appreciated between 600 and 1,100% respectively, while AT&T actually declined. Now, this is one example, but I can show you a number of examples where this was the case.
And the reason why this is important too, if you go back and yield on cost and you go back to the slide there where we talked about a lot of these companies have policies around their dividends. They have dividend policies. A lot of these companies have the policies that they're going to grow their dividends. So there's correlation between your growth of your dividend and that growing that income, because as we touched upon earlier, dividends declared has to be paid. So that dividend can't be faked. You can do a lot of fancy accounting and all of that, but as you pay a dividend, it has to be faked. Can't be faked. So if your income, your yield on cost, that dividend is growing, there's direct correlation over time. You will likely achieve principal appreciation of that stock as well. Dividend growth is an early indicator that you're more than likely going to have long-term appreciation in stock. Can't grow a dividend without growing revenues, without growing earnings. What drives stock price? Earnings per share. Earnings per share. So it's all correlated. It's all tied together.
So we thought that we got a lot of questions. Sorry.
Mark, before you guys move on, I see people are starting to put some questions in. Do you want to take a moment to address one or two, or should we keep going?
Sure.
Yeah, we can do that. Thank you for that pause, because we were planning on doing that too.
Yeah, so you may have addressed this, but I'm not sure, maybe I missed it. But what essentially is the difference between yield and yield on cost?
So the difference, so the yield again is a income a company produces at a point in time, right? So that yield can move around quite a bit depending on what the stock price does. It's dependent on the stock price at any given time. Yield on cost is basically the growth or that income based on your initial cost basis. So it's like your personal rate yield. So it's more personalized because it's based on the cost basis. And for dividend growth companies, where we maintain companies that have grown they're growing the dividends 10% or more over 10 years on average, you're going to see that numerator increase, so that the price you paid for that stock is not going to change. It's going to stay wherever you purchased it, but that income is going to grow over time. So when you look at our companies or typical investment companies over 10, 12, 15 years, not to say that the underlying stock price doesn't make any difference, but you start to get to a yield and costs that are in the double digits and higher, and the underlying, the value of that underlying stock becomes less important when you're talking about income. Does that make sense?
We have a chart, we have an example here we can show to answer that question as well, the two ladies.
Yeah, so this was, you preempted a little bit our next example. And what we did was we looked at two different investors. We sort of characterized as Robin and Mary, and measured them based upon their same initial investment of $100,000. And we looked at that over 20 years. So if we basically look at one where Mary was more focused on the initial yield, so she wanted an investment that had a higher initial yield of 3%. And then we had Robin, who's more focused on the growth of that income, even though she started with half the initial yield level. If you look forward 20 years and you looked at the growth, the actual income at the end, this is the annual income, this is not accumulation, the annual income of that investment far exceeded that of the higher yielding investment. So there's a material example of the difference, the income growth, the compounding impact that would have on an initial investment. One with a higher initial yield, focus on yield, one goes focus on dividend growth. And you're going to see this play out time and time. I don't have to run a Monte Carlo simulation with just about every company that's growing its dividend. You're going to see that if they maintain that dividend growth policy, that over a measurable period of time, you're going to have greater income growth from that investment versus one that's flat or stagnant.
So I think that example, I hope, is really the difference on yield versus yield on cost. So I think we've got some other messages coming through. So we're gonna pause for a minute and answer some of these questions if we could do that. So we've had a number come through here. Double check here and see what we've got here.
I see some in the chat. I'm interested to hear about double-digit growth. How do most ultra high net worth families fit and incorporate dividend growth investing into their investment picture?
Yeah, that's a great question, because that's the bulk of our client base, and where they fit that into their investment picture. It's usually kind of three areas, to be quite candid with you. It's three areas. We're usually a solid, what we call this in a sleeve or a portion of their portfolio. We're stable. We have a couple clients here refer us to as, you are my sleep at night. I can put my head down and know this portfolio here that's with you all is going to be solid, consistent, steady, and the income growth, I'm going to use that to do whatever I want to do with the income, and I know it's growing. The third, second, we get a lot of trust accounts here. Because if you're familiar with trust accounts, you have remainder bennies and income bennies, and usually your income bennies take an income. Well, what do we do here? We grow income, we distribute income with those assets. So we're positioned quite nicely for those, but you also have a remainder benny. So that remainder benny truly wants to know that portfolio is there, it's protected, it's growing. So we get a lot of assets. We're trust assets. And third, we get a lot of charitable assets for the same reason. So those families that work with us are coming to us for those real three areas in that high net worth space. So and We have clients here that are using that rising income. Some are feeding it into business lines, some they're using it to meet their cash flow needs. So that's some of that as well. A couple other questions in here.
You want to answer the other question for that ratio dividend income?
You wanna raise- yeah.
Yeah, so I'm going to address there's one question about the ratio of dividend income versus growing principal. So the principal growth obviously depends on market conditions. We typically are somewhere, 80% of the overall market return, sometimes a little bit higher, sometimes a little bit lower. But it's that income, because we are so diligent about focusing on companies that have grown their dividends 10% or more, that we can't guarantee, but we can rest assured that if a company doesn't meet that hurdle, that they're removed from the portfolio. So that income growth over the long term should be at least 10%. Now, in actuality, it's been higher than that, but that's our we talk about our hard deck. That's our minimum investment criteria for something to remain in our clients' portfolios. So that 10% should be construed as, it may fluctuate depending on the year a little bit. Some years higher and lower, but when you look at over the long term, it's been remarkably consistent of at least 10% or more. So we have much more visibility on that income growth versus we can't really predict what the market's going to do in the future.
So yeah.
Hopefully I can answer that question. Is there any other questions we want to address right now, or?
We've got a question here on improving income from our investments and develop a favorable tax strategy. I think we're going to cover that.
We're going to cover. You're preempting our slides. It's all good.
So
Yeah, why don't you guys continue and then we'll come back to some more
Yeah.
questions.
Just flip to the next slide. So one of the things that, on everybody's mind, especially lately, is inflation and inflation protection. And these dividend growth investments are actually a great hedge against inflation. It's actually fantastic. So we set an example, that if stock price, and we're bringing price action, price increases by 3%, and that inflation is 4%, then on a net basis, you're actually behind the curve there. You've lost sort of 1% in total purchasing power. But think about it, if that same stock increases by 3%, but then you have a 3% dividend yield of one that's growing, you're ahead of the curve, right? You're ahead of inflation. And this is the kind of power that dividend growth companies have. And one of the things about dividend growth companies that we're going to kind of reiterate, because they're quality companies, they have pricing power. So if they experience inflation, which they have over the past couple of years coming out of COVID, they've been able to raise their prices, increase their revenues, increase their profits, and increase their cash flow. And a majority of that is going through into, or a certain percentage of that is going through to increase their dividends.
That's right.
So our experience more recently has been that it's actually been ahead. The companies have increased their dividends ahead of the inflation rate. And that's really powerful. And we think that that's the reason really supports our thesis that these companies in the future are going to continue to increase their dividends in the excess of inflation. So
That's right.
you're getting inflation protection. Again, we can't predict what the stock price is going to do in the future. But when you look at the cash flow these companies are paying, it's more than keeping up with the rate of inflation.
It is. And if you think about what we mentioned earlier, with ours is 10 years at 10%, our income streams off our portfolios are averaging 10% or more over the last decade. Okay. So if you are taking an income stream off of these portfolios, your income stream is growing at a pace faster than inflation. And we're seeing it, our clients are seeing it. In 2022, our income growth was 12% year over year. Last year, we were 30% income growth last year off our portfolios. Our 10-year average right now is running about 12.5. So if you're familiar with the rule of 72, you take your 10%, divide it in 72. That's how long it should, on average, take something to double.
She's 7 and 8 years.
So between 7 and 8 years. So if you're using a dividend growth portfolio to support income for you, that income stream will double over 7 to 8 years will double. So it's inflate and it's outpacing inflation.
We're not accommodating any sort of market appreciation. This is pure income. So we had a question about the tax advantages, so we're going to address that next. So it's important to highlight there's two types of dividends, one of which for obvious reasons we focus on in our investment process, but there are ordinary or non-qualified dividends. A lot of it has to do with the holding period, but the important thing to know is that, like we'll talk about this later too, about fixed income and some interest income. A lot of this is taxed at the clients or investors' marginal tax rate, which is 37% right now. Probably it could go up in the future, but as of right now, it's in 30%, 37% tax range at the maximum range. So you're not really getting any interest shielding here when you have ordinary non-qualified dividends or any kind of income in that matter. We, on the other hand, focus on qualified dividends. So we're long-term holders. Our average holding period is 5 years. Some companies we've owned for 20 years. So we don't ever have any problem with making the distinction between qualified and non-qualified. The vast majority of the time, our clients are receiving qualified dividends. And why that's important? Because it's being taxed at a lower tax rate of more in line with long-term capital gains. Now, there's 3 different tranches right now so it's 0, 15, and 20. It just depends where that individual's tax rates are, but it's a significant difference. 20 is a significant difference in 37. It's almost half. It's almost half. So, we're able to manage our clients' portfolios to receive those qualified dividends and avoid the pitfalls for non-qualified dividends, which is really important. And then we would talk about, roughly address some of the questions we get about fixed income. So we're not saying that, that dividend growth is suitable for every client's portfolio without any contribution fixed income. The fixed income definitely has a place. But if you look at longer duration assets, which our clients typically have, there's really it's the definitive advantages of using a dividend growth strategy versus fixed income. And some of that has to do with the fact that, fixed income by its name is fixed, right? So you're not going to get an increasing stream of dividends by and large. And even when you think about inflation and purchasing power, you're not really protecting your purchasing power by buying one of these bonds. Even if you invested in inflation protected treasuries or TIPS, which are supposed to keep up inflation, guess what? In actuality, they don't. And if you've looked at them over the past several years, they've actually lost value, which is pretty incredible when you think about it. So the principal value has gone down. Now they've kept a certain yield, but they've actually lost principal value. So you're not going to get much inflation protection from fixed income, even if you invest in TIPS. The other thing is that a lot of the income that you're getting from these bonds is taxed, with the exception of municipal bonds, taxed at higher rates, actually the marginal tax rate, which is up to 37%. So you're not getting qualified distributions for any of these investments. So not only did you not keep up with inflation, you're winding up with a higher tax bill. So, we believe that, especially for longer duration assets, that the power and the income growth from dividend growth is more compelling when you look at it over the long term than if you compare it to fixed income. So, again, we understand, you also have the potential for capital gains. So we're not even looking at the appreciation in the stock, which is a whole other story. Those two would have the advantage of tapping in tax at the long-term capital gains level. So as of right now, where the tax regime sits, where we sit now from a fiscal standpoint, we see there's a lot of advantages to be invested in dividend growth versus fixed income investments. So we're just gonna kind of summarize what we've been speaking about today, and some of the reasons why, we believe that this is such a superior investment strategy.
Yeah. So, double digit for decade of growth or more, it goes back to you got 10 years with a 10-year track record, 10% or more in income stream growth. It's going to lead to likelihood of income and principal appreciation over time. So, some of these questions that were coming up, I'd like for us to answer some of these as we move forward, but I don't want to read through the summary. Hopefully we've gone through the chart and enough information here today that shows the unique distinction of what we do and why it's valuable in a long-term portfolio for clients. So where are those questions?
Let me see here if I can try to pull those up.
Chat, go back up to chat. And left there. So we had some questions here around, I'd like to spend some more time answering some questions here that came through. And John, I don't know if you have any other questions, but we're seeing some here.
Yeah, I mean, somebody's asking about a 2 to 10 year outlook for dividend strategy. What percentage of a client's 2 million portfolio would you consider appropriate for your investment strategy?
The 2 to 10 year outlook for
That's a-
dividend strategy, well, can never sit here and say for certain what 10 years will hold, but as we all know, time in the market, more than likely you're going to have principal appreciation. The likelihood for us is we do see that long-term 10-year outlook to be pretty good, especially the next 5 years. We think we're going to be a decent market. Reason being is there's a lot going on with productivity increases. All this AI that we're seeing, all this new technology rolling through, efficiencies in companies, it's everywhere. We're seeing a similar dynamic that today that we saw back in the 90s. So if that continues to play out, we should see a pretty good market here in the next few years. What percentage of the client's $2 million portfolio would you consider appropriate? The answer to that, and I don't mean this to sound wishy-washy, it depends. It depends on the client, depends on what the true needs are. We have clients here where 2 million would be in a 100% dividend growth portfolio. We have clients here where 25% being fixed and the rest being in dividend growth. Just depends on the nature of the client, what the true need is from that standpoint.
It's interesting, Jim, that when our clients, when they start to get that yield on cost, when it starts to really accelerate, they're not, not that they're not worried about the principal, but they're like, they come in and ask, how much money did my income grow year over year? And we're always able to, you're like Santa Claus, we're always able to give them the good
That's
answer.
right. That's right.
They're always
That's right.
like, gee, that's great,
That's right.
so that's kind of reassuring. I mean, I think that it's important just to focus on that. And you're actually de-risking the portfolio over time because of this income growth.
Right. So it's so that answer is depends. We have a lot of clients here. We have to have conversations to try to reduce fixed income because of the nature of what we do. That when as Mark touched, we don't necessarily think you don't have to have fixed income in a portfolio, but you may not have to be as exposed as you think.
So another good question here.
What are your feelings about lofty? Go ahead, Mark. Go ahead.
No.
Oh, no, I was going to say it kind of lends into another question I had. I mean, your investment strategy, I mean, what's the profile for someone that should consider a dividend growth portfolio?
Yeah, I got this asked the other day. I said, we had a client here said, my grandson, we're getting ready to give. Should my grandson be in a dividend growth portfolio? And the answer to that was absolutely.
Yeah.
Because the compounding effect of that over
Long
20,
duration.
30 years.
It's a long duration
Absolutely.
portfolio.
Absolutely. Because of it's a long duration compounding, the yield on cost would be astronomical. If you ran that out over 40 years, it would be mind-blowing. So for us, a typical profile, our typical profile client here in the private client group side, they're successful, they're family-owned businesses, they're generally 50 and older. They're looking for stability. They're looking for wealth. They're looking to grow their assets, but have some for wealth preservation. They're looking for income. Those are our initial kind of profile clients. But we have families here where we have sizable 8-figure relationships where we're just that solid, steady core, and they're doing their private equity deals, they're doing their business deals, they're doing their real estate, but we are that solid, steady core that's there. So the profile, that's our profile. We have a lot of grandchildren we work with for the compounding effect. We also have that successful family that a lot of successful families that we work with too. So.
If I should address, there was a question up there I see in the chat about different payout ratios, what's too high, and then talking about interest rates and market outlook. So talking about dividend payout, which is important. Many of our companies have stated dividend payout policies. It may be 30–40% of their net income. They're typically generating cash in excess of that. You know, the vagaries of financial accounting. You know, earnings aren't typically cash earnings. Cash earnings are typically higher, but these companies have strict cap allocation policies. When we look at, say, the universe, and if it varies from year to year, 180 companies, 190, 160. You know, we're constructing portfolios of about between 30 and 40 different investments or different companies, and we are doing that screening to make sure that, you know, companies aren't paying a high dividend and liquidating either their current balance sheet, you know, taking on additional leverage, or impacting their future growth capabilities, because that dividend growth it's so important they maintain that growth capacity. So we are very mindful of that when we go through our analytical process. We're constantly talking to our companies one-on-one. We speak with them a couple of times a year. We're obviously monitoring their financial progress, but we are actively engaged with our investment companies. As far as what our interest rate outlook, you know, it's a little bit muddled right now. We, you know, started the year with much more aggressive outlook from interest rate cuts. Inflation has been more persistent than we expected. Some of that's good. It's because the economy has been strong or remained strong as the Fed tries to engineer a soft landing. But our expectations are still, you know, 2 to 3 rate cuts this year. It may take place a little bit later in the year than we thought 6 months ago or even 2 months ago. But we still think that the Fed eventually is going to be on a loosening path. And as far as the PE ratios, I would also say that people talk about recession. I would tell you, coming out of COVID, we got the big boost, and then we're kind of settling down, and we've had a rate tightening cycle. There's been a bit of a profit recession. So I think it's important to note that cyclically, if you think about the first in, first out concept of companies that started, industrial companies, some of the technology companies, the chip manufacturers, you know, they've seen weakness over the past year. So there's been a little bit of a profit recession. So during those times, typically you'll see an expansion of market multiples. But if you look beyond those top 5 or 6 stocks, you know, the Nvidias, the Microsofts of the world, Apple's, the overall market PE is within a reasonable range. And we think that as earnings catch up, because we're going to see this productivity growth, we are going to get a loosening monetary cycle. That's what gives us more confidence about our market outlook in the future. While we think that now is a good time to be investing if you're a long-term investor. So yes, there are some, you know, lofty PE ratios. Some of that has to do with where we are in the economic cycle. But when we look out the next 3 to 5 years, we're very optimistic on what's going to happen in the U.S. economy. I hope I was able to answer your question without getting too detailed. There's something here about improve income from our investments and develop a favorable tax strategy. Again, we would refer you to a prior slide where, you know, qualified dividends have a much more favorable tax policy. I would tell you, and probably, the policy taxation group is probably better able to answer this, but it does seem like whichever administration comes in the office or gets elected this year, that they're going to have to raise revenue somehow to pay down some of the deficit spending that we've incurred. So there could be a change in tax policy. We hope it's not, they make us pay unrealized capital gains, but there's probably going to be a strong push to try to raise some income some way to lower our deficit.
So Mark, related to that, I mean, you're talking about, influences, the government and so forth. How about global events? How does that affect dividend growth? I mean, we had an earthquake today. We've got a war in Ukraine, a war in Israel, other geopolitical threats around the world. How do you take that into consideration in your model?
Yeah, that's a great question. There's a couple of things that we look at. So even within our core investment universe, we have very broad geographic exposure. So while it's true that the majority or all the companies in our clients' portfolios are listed here, they are global businesses. And so, and even if you look at their income growth, 50% or more is based on global growth around the globe, whether it's in developed markets or emerging markets. So you're getting that diversification, you're getting that exposure to different regions, different areas. There's clearly been a decoupling that's occurred both after Russia's invasion of Ukraine and some of the issues going on in the Middle East, along with our relationship with China. And we feel that onshore and nearshore is actually having a significant advantage to the U.S. economy that's going to be maintained. I don't think that trajectory is going to change. And I think that push is going to make U.S. companies and even European companies more dominant, and especially the companies that have the cash flow and fiscal discipline that we see in the companies that we invest in.
Sure.
So even though there's that geopolitical volatility, our companies have actually benefited disproportionately as a result of some of that volatility.
That's right. And the other thing about the discipline of what we do, because of how we screen and how we carefully we monitor these companies very carefully. If that dividend growth rate is starting to decelerate, okay, that's an indication for us that we need to start paying attention about what's going on with that company. So we monitor that, we look for that. And if we start seeing that, I call it check. It's like check engine.
Yeah, early warning.
You better start paying attention here as to why that growth rate is starting to decelerate, starting to drop. Because you're remember we talked about there's only 6 things you're going to do with cash. You start moving away from paying a dividend, you better figure out why. So it's an early indication for us from that standpoint. So.
Okay. Well, I see we're coming up 10 minutes on the hour. I don't know if you want to do more questions. I was personally curious. I mean, I think you answered it, but maybe you want to have a chance to just kind of conclude with this and any other concluding remarks you have. I mean, in terms of your firm, how do you feel like you're unique and differentiated from other investment firms?
Yeah, we're number one. It's our ownership structure that makes us very unique. We're 100% employee owned, so all our clients and all of our employees know, and our clients know who we're here to serve. We're employee owned,
and we're independent.
That makes us unique as well. The discipline makes it unique. Our discipline makes us unique, and we're small. We're a powerful firm. It's interesting. I got a phone call the other day, and I actually answered the phone. And somebody said to me, "I can't believe you're answering the phone." It's like, well, we're a 12-person firm, and I'm fourth on the phone chain. If some other 4 other folks are on the line, it comes to me, I'm going to answer the phone. So that makes us a unique, differentiator as well. That we are small in size, and if you need to talk to our CIO is going to answer the phone. So that makes us unique too. So
you pick up the phone. The other thing I would say if you just interject or add, a lot of companies, it's kind of the flavor of the day, dividend growth, and we've been doing this for 50 years. I don't think anyone has a track record that we do. But I think more specifically, the fact that we use a 10% of hard deck for our investment criteria is unique. I don't think there's no one else out there that's doing that. They have maybe 5%, or the companies that just have to grow their dividends. The fact that we're able to maintain that 10% discipline is really important, because if you think about the compounding impact of a company that's growing its dividend 10% or more, you start to get an exponential sort of contribution from that in the out years. Even if you hold the investment for 10 years, you'll really start to see that hockey stick. And I'm going to put my engineering hat, go from a square to a cubic root. You can see, you see it's got hyperbolic. I mean, it really starts to be a meaningful cash engine, contribution engine, as the longer we hold that investment, provided that is continuing to maintain that 10% or more rate. So that's a really important distinction that we have, and something that we're very much focused on. It's easy to talk about. It is difficult in practice to execute, because you have to maintain that discipline. I gotta be quite honest with you. There's times like, I really love this company, but it's falling below our 10% rate, and it can no longer be, based on our mandate, it can no longer be in our clients' portfolios. It may come back again, John. It may come back. It may come back in a year or two. We'll consider it. And we're not, again, our holding period is pretty conservative. 20%. It's a 5-year average holding period. So we're practicing what we're preaching. We're not trading around companies. We shouldn't need to. When our companies go on sale, we get excited. If you think that the fundamentals haven't changed, this is a buying opportunity. It's like going to Macy's and something's 50% off. I get excited about that. I'll fill my bag with that merchandise, and there's something similar when it comes to our stocks.
That's right. There's a question here I'd like to answer here. It says, what are common mistakes that we need to avoid? The biggest thing we see being over diversified. We see it all the time. We have accounts that come in here with 250 holdings, and you're like, and
overlapping too. If you actually look at the investments and did a deep screen, they own,
right. And you can have a diversified portfolio of 30 to 45 names, and you'll be just as diversified as that model a lot of folks are being pushed to models today. Those models are so over diversified, and the fee structure on that is amazing. So having a 35 to 40 name portfolio of stocks that are mid, small, international, you're going to be just as diversified as that portfolio that's on model 250 to 300 names. So that's a big mistake. You see a lot of folks make. Big mistake.
I think it would be almost impossible to actually track those with any effectiveness.
Yes.
So many names.
That's right. So, but
we have one more question. I don't know if you want to take a minute to answer it. They're investing. What portion of your investment will be in munis?
Yeah, we have clients here that have munis, anywhere from 25 to 35% in munis, and it depends. It goes back to depends on what we're trying to do and dampen, but because of the nature of what we do, we get a lot of flack for this. The 60-40 portfolio, but we just showed you the benefits of a dividend growth portfolio, how it measures, stacks up against fixed income. So we tell clients all the time, you can have fixed income. We don't think you need to have it at a 40%. We can do 30, 35 and still have that dividend growth exposure. But from a tax efficiency, munis with a dividend growth portfolio, you're pretty tax efficient. And we do that. We have clients here that have munis with us. We keep that up. We try to be around 30, 35%. for the meeting, for that bond.
Yeah, we want our clients to be able to sleep at night
Yeah.
and, so that gives them some comfort.
So, any other questions coming through here? I see a few, but I think we've answered most of them, but
Yeah, I think we did a pretty good job of getting through them.
yeah.
I see on your slide, if anybody wants to get in touch with you, you've got your contact information there.
Yeah. Yeah.
Um,
So,
I will say that this has been recorded. We will distribute it to our email list as well as put it on top of our YouTube channel. I want to personally thank you both for presenting. I think everybody would have found this information very valuable. I was personally fascinated by some of your insights. Quite an impressive approach and track record you have here. So I thank you. I thank you both for today's webcast, as well as for being a strategic partner of Policy and Taxation Group. You guys have been great supporters, and as you know, we can't do our important mission. We can't fulfill it without our supporters. Just so anybody new on the call wants to get to know more about us, check us out at policyandtaxationgroup.com. You know, we've been since 1995 the leading advocacy group working in a very bipartisan manner to reduce and eliminate state tax, gift tax, and generational skipping transfer tax while blocking increased income and capital gains taxes, blocking the creation of a wealth tax, and other hostile tax policies that punish success. With that said, I'll turn it back to Jim. Mark, any concluding remarks before we wrap up?
no, I just thank you for the opportunity to be a part of this. Thank you for your all support. And thank you for giving us an opportunity to present today. So we really appreciate that. And any comments, Mark?
Yeah.
We really highly value our partnership
Yeah.
with you.
It was great. It was very insightful. I'm very impressed. I think it resonated with our audience, and people will walk away really feeling like you added value to their understanding of this approach. So thank you, and thank you all of our participants for joining us today. And if you want to share the recording, we'll be distributing that. So thank you.
Thank you, guys.
Yeah, thank you, John, and to your team too.
Thank you, everybody.
All right.
I think I saw Pat on there. Thank you,
Yeah,
Pat.
thank you,
too.
Pat.
So have a great
We'll end
everybody
it
have a
on
great
that
week.
note. Everybody have a great day.